Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located here in Oakville, Ontario, Canada, a smaller town west of Toronto. My mission is to become the Google map for hardworking Canadians seeking financial freedom. And today we are going to talk about this crazy topic: how to purchase your primary residence in a corporation, especially for those small business owners who retain a large portion of their net income inside their corporation because they are trying to take advantage of the small business corporation tax rate of 12.2% in Ontario instead of taking all the money out and report everything in their personal name, whereby they would have to pay as high as 53.5% tax. Hey there, sorry to interrupt the video. I know you're learning something valuable, and I love sharing strategies to build wealth and achieve financial freedom with you. But if you want to learn even more wealth building strategies from top experts like Derek Foster, Jesse Itzler, and if you want to achieve financial freedom faster so you can finally live your best life, then I highly recommend that you save your seat at the upcoming Wealth Hacker Conference that's happening on November 12th, Saturday, 2022, live in Toronto. Whether you are a real estate or stocks geek like me, or you are a crypto head, or even a business owner or aspiring entrepreneur, grab your tickets now because we'll be sharing all the best practices for building wealth across these asset class at the Wealth Hacker Conference. Come November 12th, live and in person in Toronto. And now let's get started. A couple weeks ago, a client has come to me and asked me this question. Hey, I now set up the corporation, I earn all my income in the corporation, and I follow the golden rule to limit the amount of income that I'm drawing out from the corporation. And I'm living in this smaller house and I am growing my family. I need to buy a bigger house. How am I able to leverage the retained earnings that I accumulated in my corporation and take advantage of that and help me purchase my dream home or forever home? Now, this is a great question because a lot of small business owners are doing the exact same thing, because in the corporation, when you earn the income in the corporation in Canada, you are enjoying the low tax rate, the corporation tax rate. And typically, if you earn anything under 500,000 net, anything net of your expenses under $500,000, you're entitled to the Canadian, the small business deduction rate, which is in Ontario, is 12.2%. Now, on the other hand, on the flip side, if you report everything in your personal name, you pay as high as 53.5% tax rate. So 53.5%, 12.2%, you're still owning all the cash. You would always opt for the 12.2% income tax rate. So the idea for a lot of small business owners is to leave as much money as possible in the corporation. You can invest, you can reinvest in your business, use the retained earnings to invest in investment properties, you can buy bonds and do whatever you want within the corporate structure without triggering another layer of personal income tax. You're like my client, you have a large amount of retained earnings accumulated in the business inside the corporation. As you know, if you take the money out directly from your corporation to your personal name, there is a tax implication. You either have to take it out as a dividend or you have to take it out as salary. So you will have to pay that 53.5% tax that nobody wants to pay. So is there a way that we could help our client to purchase their primary residence, the big home that they always wanted, in their personal name? Okay, there are three options available for my client. The first one, which is not very commonly used, is to borrow money to make a loan arrangement with the corporation that my client owns. So essentially, as a shareholder of the corporation, you would borrow money from your own corporation, the retained earnings. In exchange, you would agree to pay your corporation an interest payment on a regular basis to repay the loan. Under this arrangement, my client would borrow the money and use the fund to purchase their forever home. The downside of this arrangement is that CRA doesn't like the shareholder borrowing money directly from their corporation. There's only one exception that you would be allowed to do that. Is that if your corporation, your business on its own is making this type of loan, employee loan arrangement available to all employees, including the arm's length employees that you are not related to. So if my client is a solopreneur, so essentially you only have one person, you're working for the corporation pay you salary or dividend, you are not qualified to use this type of arrangement to borrow money to purchase your forever home. This won't work for you because CLA could come back and say, hey, you took out money from the corporation, and this amount, let's say it's $200,000 that you're borrowing. This $200,000 CLA could potentially deem it as shareholder benefit, and this $200,000 would be added to your personal income, which then would trigger the personal income tax rate being dinged on the $200,000 income, and you would have to pay the personal income tax on it. So it may or may not be applicable to you, but if you have a bigger business and you have employees and you're making this employee loan available to all the employees that are, including the employees that are not related to you, if you can prove to CLA that you are borrowing the money in the capacity of an employee, then you would be able to borrow the money and use it to do whatever you want. But you must be able to establish the ground that you're borrowing in the capacity of as an employee rather than being a shareholder. Now, another downside that option number one would have is that if you are borrowing money from the corporation, the loan receivable recorded on the corporation is not an active business asset. It's not an asset that's producing active business income for you, so not generating business income for you. So this would potentially jeopardize the qualification of lifetime capital gain exemption if you were to sell the shares of your business. If one day you decide to sell the shares of a small business, in Canada, you could potentially shelter $900,000 capital gain on the sale of qualified small business shares. And to qualify for this $900,000 capital gain exemption on sales of shares, the assets of the corporation, 50% of the last 2 years have to be used for active business purpose to generate active business income. And the day of closing, the 90% of the asset must be used for active business purpose. So by lending the money from your corporation to you as the person, that asset, depending on the amount of the asset in relation to all the other assets recorded on the books, it may jeopardize the qualification of lifetime capital gain exemption, and therefore you may not be able to shelter the capital gain if you were to sell the business. Option number two is my client would be able to purchase the property directly in the corporation. It's simple enough. You see your dream home and you have a large amount of retained earnings saved up in your corporation. The easiest way to do it is to use the corporation money and buy directly inside the corporation. In this way, you would not need to draw out a large amount of money from your corporation and report it on your personal income tax return and pay personal income tax as high as 53.5%. The downside of this arrangement is that you would have to pay a fair market value rent to the corporation. Now, that's because the corporation is buying an investment property in the corporation's eyes. And in CLA's eyes, it's renting it out. It's just so happened the tenant is you. Because the client is related to the corporation, typically the transactions between related parties in the eyes of CLA would have to be at fair market value. So my client would have to pay a fair market value rent to the corporation on a monthly basis to cover the expenses, as well as to not have negative shareholder benefit triggered on the personal income tax side. So the client would have to pay a fair market value rent to the corporation. And the corporation would pay all the mortgages, property tax, or whatever the rental arrangement work out to be. If there is any rental losses, the rental losses generated in the corporate-owned property would then be claimed within the corporation tax return. And if there is rental losses, again, the losses can be used to offset against your business income. So it's not necessarily a bad deal. Now, on the flip side though, under this particular arrangement, you would, as an individual taxpayer, as you know, in Canada, like the biggest tax-free asset you can get in Canada is your primary residence exemption. So in this particular case, if the client owns a future home, the dream home in the corporation, the client would lose the ability to claim the property as his primary residence, would be subject to capital gain tax on the sale of that particular property. The corporation will be the one that's paying the capital gain tax. Now, in terms of the lifetime capital gain exemption that we mentioned on sale of the business, this whole arrangement of having the corporation own the future home, corporation own the second home, again, it will also affect the individual's ability to claim the lifetime capital gain exemption, depending on the fair market value of the property and in relation to the asset, the business asset of the business. So it may still affect individual taxpayers to claim the lifetime capital gain exemption on sales of shares if the individual decide to sell the business later on. The last tax impact that could potentially happen is if the net rental income received by the corporation is over $50,000. So net rental income meaning the rental income, the fair market value rent minus mortgage, interest, insurance, property tax, and all the eligible expenses. The net rental income is exceeding $50,000 or any passive income all added up earned within the corporation exceeding that $50,000. If that's the case, anything above and beyond that $50,000 that's earned in the corporation would lower the small business deduction limit by $5. So let me use an example to explain. Let's say the company earns net rental income of $50,001. So only $1 over the $50,000 limit. That $1 extra is going to lower the small business deduction limit from $500,000 to $499,995. So what does that really mean? Typically, for a small business to qualify to pay the small business tax rate of 12.2%, the net business income has to be lower than $500,000 to qualify for the 12.2%. Anything above that $500,000 or the small business deduction limit would be subject to 26% tax rate in the corporation. So in that case, if the corporation earns more than $50,000 of passive income, in our example, it's $50,001, and that extra $1 is going to lower our small business deduction limit from $500,000 to $499,995. If the client is earning over that $500,000 net business income, a portion of that income is now going to be taxed at the 26% instead of 12.2% income tax rate in the corporation. So that's why you have to be careful in terms of how much passive income you're earning. And there are tax planning strategies that we could potentially apply to lower your passive income as well. So make sure that you speak to a professional accountant to put the proper strategy in place to minimize that impact. We have option number 3, which is something that I've seen and I've recommended multiple times to my clients as well. If you already own your primary residence and you have a large amount of retained earnings sitting in the corporation, one thing you can do is you could potentially consider selling your existing primary residence into the corporation that you own. The reason why you do it, yes, it will trigger land transfer tax, so it does trigger transaction costs, land transfer tax as well as legal fees when there is ownership changeover. The reason why we would do that is because presumably the client owned this primary residence for all the years that he's lived in, and it is a primary residence, and in Canada the biggest tax-free asset that you can get is primary residence exemption. So this client, when he sells the property to the corporation and trigger the land transfer tax, he sells it at fair market value, and there is no capital gain tax exemption. The corporation turn around and take the property and refinance the property and purchase the property with a brand new mortgage and use the proceeds to pay the client back. And the client takes the money out in his personal name. There is no income tax other than the land transfer tax, and then use the proceeds to buy his forever home. Now, under this particular scenario, he retrieved a bunch of retained earnings from the corporation and used the money to finance the purchase of his primary residence home. Now, under this scenario, the corporation is able to still generate rental income on the old residence, and it's properly treated as rental income, and the new residence is in the person's name, in the taxpayer's name, he can continue to apply primary residence exemption on this particular property. So all the future appreciation of this new home would be tax exempt, assuming the client is using it for primary residence purpose. And then the benefit of this is also that there is no negative tax implication. You don't have to pay rent into the corporation, and you're now retrieving a bunch of cash from the corporation to your personal name, and you can qualify for the mortgage accordingly. Now, the downside of this is similar to all the other options that mentioned before. There is the negative tax impact potentially on the small business deduction. And for anything over $50,000 passive income that's earned in the corporation, it could potentially reduce the small business deduction, and you would have to pay higher income tax rate inside the corporation for the business earning. It would also affect the qualification of lifetime capital gain exemption, because now you have a large amount of asset for rental purpose that you are holding in the corporation, and depending on the fair market value of this rental asset in relation to the business asset that's owned, it may affect your ability to claim the lifetime capital gain exemption on the sale of this particular business. So that's pretty much it. I typically recommend my client to, depending on the objective of the old property, and also the objective that they have on the new property, we advise them based on the criteria that we mentioned earlier and what they want to do in the future. And if you have any questions and you would like to have a consultation with us, make sure you reach out to our team. If you like our video, make sure you give us a thumbs up. And if you have any questions, leave that in the comment section and I'll get back to you personally as well. If you find our video useful for any of your friends and colleagues, make sure you share that with them. Until next time, thank you for watching.